The wealth mechanism behind the 2008 collapse. In 2008, one decision destroyed millions of lives. It erased jobs overnight. It emptied savings accounts. It turned family homes into abandoned shells. And while the world was falling apart, a few people became billionaires. Not because they worked harder, not because they were smarter, but because they understood something most people never see. A hidden machine, a mechanism that controls wealth. This is the story of the decision that broke the world and the wealth mechanism behind it. Imagine this. You're a normal person. You have a job, a family, a small home. You're not rich, but you're okay. Then one morning, your boss calls you in and says, "I'm sorry, we have to let you go." You blink, confused. What happened? And he says, "The economy collapsed." Collapsed? How does an economy just collapse? You still have bills, the grocery store is still open, the buildings are still standing. So what actually broke? The answer is shocking. Nothing physical broke. Money broke. Or more specifically, trust broke. And when trust breaks, the entire financial system breaks with it. The first domino, the American dream. To understand 2008, we need to go back, not to Wall Street, not to banks, but to something simple, the American dream. For decades, Americans were told one thing: buy a house. Houses always go up. A home isn't just shelter, it's an investment, a savings account made of bricks. And for a while, it worked. From the 1990s into the early 2000s, housing prices rose and rose and rose. People felt richer. Banks felt safer. Everyone believed this can never stop. But that belief was the first lie. Banks noticed something. Mortgages were powerful because mortgages meant decades of monthly payments, interest, predictable profit. So banks started lending more. At first, only to safe borrowers, people with stable jobs, good credit, reliable income. But then they asked a dangerous question. What if we lend to everyone, even people who couldn't afford it? At first, that sounded insane, but the banks had a trick, a mechanism. They weren't planning to keep these risky mortgages. They were planning to sell them. Here's where the story turns dark. Banks began doing something called securitization, a complicated word, but the idea is simple. Take thousands of home loans, bundle them together, and sell them as an investment product, like this. Instead of one family owing the bank money, now investors all over the world owned pieces of that debt. Your mortgage became someone else's profit. Debt became a commodity, and Wall Street loved it, because debt meant money. But this also meant something terrifying. The banks no longer cared if borrowers could repay, because the bank wasn't holding the risk anymore. Someone else was. Subprime, the most dangerous loans. These risky loans were called subprime mortgages, loans given to people with poor credit, no savings, unstable income, sometimes no job at all. Some mortgages were so insane they were nicknamed ninja loans. No income, no job, no assets. Banks were basically handing out home loans like candy. Why? Because every loan meant another product to sell. And the machine kept growing. Bigger, hungrier, more unstoppable. The ratings agencies, the stamp of approval. But investors had one question. Are these mortgage bundles safe? Enter the gatekeepers, credit rating agencies, Moody's, Standard & Poor's, Fitch. Their job was to rate investments. AAA meant safe. Junk meant dangerous. And somehow, these bundles of risky subprime loans were rated AAA, the highest rating possible. How? Because the system was corrupt. The agencies were paid by the banks, so the banks were basically paying for good grades. And investors believed the grades. Pension funds, insurance companies, even foreign governments, they all bought in. The world was drinking the same poison, thinking it was water. The bubble. By 2006, housing prices were absurd. People flipped houses like trading cards. Buy today, sell tomorrow, profit. Everyone felt like a genius. But bubbles don't burst because people panic. They burst because reality returns. And reality returned when interest rates rose. Suddenly, monthly payments increased. Families couldn't pay. Defaults began. At first, just a few, then more, then thousands. And the machine began to shake. The collapse begins. When people stopped paying mortgages, those mortgage bundles stopped paying investors. And suddenly, the safe AAA investments were worthless. Banks froze. They didn't know who was holding toxic debt. Nobody trusted anybody. And when banks don't trust each other, they stop lending. And when lending stops, businesses die. Jobs disappear. The economy suffocates. The world was about to learn something brutal. Modern economies run on credit. And credit runs on trust, and trust was gone. This is part one, and we haven't even reached the moment. Lehman Brothers collapses, the stock market crashes, governments panic, and billionaires are made in the rubble. Stay tuned for the next video.